So hello guys, in this video I'm going to share with you one of the simplest and then highly profitable supply and demand strategy in the SMC industry. What I mean by SMC is simply smart money concept. Now with this strategy, we are only looking forward to trade one single pattern, and that pattern happens repeatedly in the market, and this is the pattern. This is the only structure we are interested in trading. Once you see this structure, we take the trade, and this structure actually gives you a decent risk to reward, a minimum of 1:3 regardless of the time frame you are trading. So this is simply the structure we are looking forward to trade, and I have personally been trading this structure. I've been live streaming this structure, and I'll be sharing every single live stream and also taking data of how it works. Now you can see over here from August to September 5th. So you can see from August to September 5th, I took a total of 1, 2, 3, 4, 5, 6, 7, 8, 9. I marked at 9 trade. I won 6, lost 1, had a break even on 1, and then I had one that I actually missed. I missed the opportunity, but it ended up playing at war. And the benefit of all of this is that this strategy gets to give you a higher risk to reward ratio, which gives you more profit than your losses. You can see this strategy is also backtested, and then with data already saved in here. Now without wasting much of your time, let's get straight. Let me share with you a step-by-step guide on how you can actually trade this strategy. Now I know a lot of you might have been watching several videos about supply and demand and all of that. Now what keeps this one separate is that this one doesn't just tell you to trade every random supply and demand you see in the market, but it gives you specific criteria to consider some high-level supply and demand areas. Until you come across those areas, you don't trade them. That's why this strategy actually comes with a pattern that we trade, and the pattern looks in this manner, whereby the market leaves a particular point and it gives you a demand level, and it gives you a pullback, but then the pullback doesn't get to the demand level, whereby giving you a liquidity pool here. Now after the market gives you this liquidity pool, we all know that the market is likely to come back to tap out this liquidity. So for that reason, we wait for the market to pull back into the demand area that it created earlier on by sweeping out this liquidity, and then we'll get in and straight to our take profit. Pretty much that simple and straightforward. Now, however, as much as it appears simple, it's not really as simple as this to trade. There are some things you need to do in order to get it right. And for that, we are going to work with a specific time frame, which is we are going to work with the daily, 4-hour, 1 hour, and 30-minute time frame. Now, these are the 4 time frames we are actually going to use for this video, so you can just write it down. Now, on the daily and 4-hour time frame, we are actually on those time frames to actually identify the market direction. So the first section of this video will be about identifying the market direction. For that, it will be done on the daily and 4-hour time frame. Now after that, the 1 hour and 30-minute time frame will focus more on identifying the key supply and demand levels in the market that we should consider trading from, and also what should determine when we enter the trade and when we get out. Very important. Now after these 2 sessions, then we are going to go straight into some backtesting. We will do some backtesting to show you a real life market movement, a past data market movement, to actually prove this strategy to you as well. So now let's get straight to work. Now here is the market. As you can see right now, this is GBP USD, the live market movement. This is Monday 9th September 2024, and this about, you can see here, this is probably 10 p.m. in my country. My laptop time is not correct. Here is it 10 p.m. in my country. So now first of all, we'll come over to the daily time frame to identify the market direction. Now the purpose why you need to identify the market direction before you take any trade is that without knowing the higher time frame direction of the market, you are likely to trade into key levels. Now what I mean by key levels is simply these are support and resistance levels, these are supply and demand levels, or key fair value gaps or flip zones that the market has created earlier on whilst moving to that particular direction that it is right now. So without being able to look into the higher time frame to identify the higher time frame movement of the market, you are likely to fall into this trap. This is why I need to be very cautious of the market. So for that reason, we need to start with breaking down the market structure. Now for those of you who don't know much about market structure, you can actually watch my video that will be on your screen right now. Simply watch that video and then you're going to learn more about market structure. Now push that aside, let's get straight to our work. Now let's use the daily and 4-hour time frame to break down this market direction. Now on the daily time frame, we can clearly see here that the market is moving to the upside. You can see that the market is moving to the upside here. Without any hesitation, the market is an uptrend. Now, before we get in, there are some terms we are actually going to make use of in this video. The term number one is simply MS. It's simply MS, or change of character. So MS simply stands for market shift. Personally, when I started trading this strategy, I use the word MS in place of market shift. There are some people called change of character. So either of them, none of them is wrong. So I would advise you, anywhere you see MS in this video, know that I'm referring to market shift or change of character. So that's simply it. And then anywhere you see BOS, as we all know, BOS stands for break of structure. Simply means market continuing its movement. And then anywhere you see dollar signs, know that I'm referring to liquidity, because I'm going to mark them out whilst we are doing the video and I don't want you to get confused. So know that what MS stands for market shift or change of character, BOS stands for break of structure, and dollar sign stands for liquidity, because liquidity is free funds in the market. Now, I believe you know this already. Now, what I mean by a change of character, for those of you who don't know, is that, let me say, assuming we saw an uptrend moving in this manner. Now, the market get to this high, and then eventually the market came back down again. Now, you see the point whereby the market takes out, when the market is moving in an uptrend, it's creating what we call the higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and then higher high. Now, by the time the market comes as low as taking out its previous higher low, that simply means that the market has printed a change of character by changing from an uptrend into a downtrend. You see, by the time the market takes out this low here, it simply means that the market is ready to change direction and no longer interested in the uptrend again. So when you see these sort of areas, I'm going to mark them with the word MS, which simply means that market shift. The market has shifted from an uptrend into a downtrend. Now, this is simply for MS. Now, what break of structure means is that for you to confirm that we have a good market shift at this point here, the market needs to give you a break of structure by also pulling back a bit upwards, but not going above this previous high that the market created, and then giving you another push down. Now, once it gives you another push down like this place here becomes your break of structure. Now, the break of structure simply indicates that the market is continuing in its new direction. So either in its new direction or in its old direction. So like, for example, for this uptrend that was going, at every point whereby the market takes out a high like this, there is a break of structure. At any point whereby the market takes out its high like this, there is a break of structure. So all these areas I marked right now are areas of break of structure. So does this one. So the difference between your break of structure and your market shift is that the market shift is when the market takes out the first lower high, the first higher low that it created in the uptrend, and then opposite for the downtrend. Now, your break of structure is simply when after the market created the market shift and then went ahead to tap out that low also, then the market gives you a market shift. Now, if it's in a downtrend, it's taking out the highs, the lower highs, and vice versa. So now I believe you've already gotten all the data. So let's get straight to work. So now, looking at those data, now let's take a look at this market here on the daily time frame. Now, if we look at this market on the daily time frame, over here we had a mini downtrend. As you can see, we had a downtrend here on the daily time frame. So we had a downtrend within this area here on the daily time frame. However, this downtrend went to a particular point and then stopped. Now, after that downtrend, if you take a look at the new market structure right now, you can see that the market is creating highs to the upside, which simply means that looking at it, we are in an uptrend. So from here, we can say the market gave us a market shift. From this point here, the market gave us a market shift here. So we can say from this point here, the market gave us a market shift by taking out this high that it created was for me this new mini downtrend here. So I'm going to consider this one, because from here, the market gave us a change of character to the downside. After pretending it wanted to go upward, it gave us a shift to the downside before giving us this one to the upside again. So for that reason, we are going to consider this one here. And now after this, same on the daily time frame, we can clearly see that what the market gave us a break of structure at this point here. A break of structure at this point here. Now, with these two in mind already, we can tell that what from the daily time frame, the market looks so much like an uptrend. But then there's a problem with the daily time frame for those of us who will not be taking our trade on the daily time frame. And that problem is that the market might be creating newer structures on the lower time frame. So for that reason, I rely on the 4-hour time frame to do those analytics. So now on the daily time frame, we confirm that we are in an uptrend already. Now let's move over to the lower time frame, which is a 4-hour. Now the honest truth is that you can do all of this on one time frame and then still get your results. The reason why I'm doing this video like this is that it's for you to get a total scope of how I'm actually breaking down the market to get my trading opportunities. Now let's take a look at this market here. Now here we had a break of structure, and then here we had a mini break of structure, but I'm not going to consider it because it's very tight here. But now if we take a look at the market carefully, the market created a lot of highs until it gets to this point here. Now you can see when the market gets to this point at the top here, it couldn't create more highs again. So it started going down. And if you look at it when it started going down, the market gave us a change of character here, because here was the last swing low that it created before it started falling downwards. So for that reason, we will mark here like this and say the market gave us what we call a market shift at this point. So I'm just going to type here market shift. So here we had a market shift, which is a change of character to some of you. It doesn't really matter. Just call it the name you know. Because the market has officially taken out this higher low that it created here before continuing downwards. Now looking at the market direction right now, we all can agree that the market is a full downtrend because we had a break of structure here. So now when I'm identifying all of these levels, I only focus on the clear levels. I don't mark every single level I see in the market. I only focus on the vivid ones that are actually giving me reasons to mark them. So if it's not clear, it's not clear. If it's clear, then it's clear. Now looking at it like this, the market is still giving us break of structures to the downside. It simply means one thing: the market is on the verge of moving to the downside, meaning it's changing from an uptrend into a downtrend. Now you can see at this point here, the market made a push upward, but since the market is unable to take out this area, we are still going to focus on our downtrend momentum. Now from here, the next thing I'll simply do is that I'll come over to the hourly time frame, which is the 1-hour time frame. So hello guys, this is simply how you get to break down your market structure to simply understand the direction of the market. Now looking at this market right now, we've gotten a clear understanding of the direction the market is moving to, and that direction is simply a downtrend. The market is moving to the downside. So now once we have this in mind, now we need to start identifying our supply and demand levels, because it's very important. But then when it comes to identifying your supply and demand levels, there are some key rules that you need to put in mind. These rules are very essential in identifying the right levels. Now here's the rule number 1. So now here's the rule number 1. The rule number 1 says a supply or demand level must either lead to a break of structure or a change of character. Now what this means is that particular place whereby you're identifying your supply or demand level should at least lead to a change of character or a break of structure. Now the reason why it needs to lead is that it simply tells you that there's more aggressive movement from that level, meaning whenever the market comes into that level, there's a higher probability that the system is going to push the market away from it immediately. That's simply what it means. Now that's the rule number 1. Now rule number 2 simply means that your candle that you are using to identify a supply or demand level must be smaller than the opposing one. Now what this simply means is that here is it. Let me say you are identifying your supply and demand levels. So let me say you're identifying a supply level. Now a supply level is identified in a market that is switching from an uptrend to a downtrend, like this particular market right now. We are looking forward to identify supplies in this market. Now to identify your supply, first of all, you need a green candle, which is a bullish candle. So not everyone uses green. So I'd rather go with the word bullish candle. So you need a bullish candle like this, and then a big bearish candle. A bearish candle that is at least bigger than the bullish one. So you need a bearish candle like this. Now this is a structure you need to identify your supply level. You need a structure like this whereby the green candle is, which is your bullish candle, is smaller than your bearish candle in a market whereby you need to identify a supply level. Now the reason for this is that it simply tells you that what, there is more power in the bearish side at this particular point in the market than the bullish momentum, because for the bulls to be able to pull out a candle that is way bigger than a bullish candle in an uptrend, it simply states that what, the bears have higher power over them. So whenever market comes to this level, it's likely to respect that same movement. So once you see a pattern like this, this becomes your supply level. So this becomes your supply level. This automatically becomes your supply level. So after this, you are simply waiting for when the market comes back here, and then you get to short it down, provided the market has obeyed the other rules that I'm going to share with you. Now this is what simply shows your supply level. So this is a supply level, as you can see. Now next up is simply your demand level. Now for a demand level is the opposite. As we all know, a demand level is going to give you a bearish candle, because a demand level is simply a downtrend switching into an uptrend. For that, we are going to have a bearish candle, and then after that bearish candle, then we get a big bullish candle as well. Then we'll get a big bullish candle like this. Now this one here becomes your demand candle, which is a bearish candle here before the bull becomes your demand candle. As simple as this. Now this is simply how it gets. This one is your demand level, this other one is your supply level. So these are the things we are looking for to actually identify them in the market. Now remember the rule number one, it states that what, it must lead to a market event such as a break of structure or a change of character. And then secondly, the candle you are using to identify your level must be smaller than the one that is moving to that direction you want to trade. Like for a supply level, we need to make sure that the green candle is smaller than the bearish one, because we are ready to go in with the bears. Now for a demand level, you need to make sure that what, your bearish candle is smaller than the bullish candle, because we are ready to go in with the bulls. Now with this in mind, let's look at this market on the 4-hour time frame. Now looking at the 4-hour time frame right now, we can see that what, this place here led to a break of structure. You can see after the market made this movement, it gave us a break of structure at this point here. This shows that what, we have so this shows that what, here is a good area to identify a supply level, because the market is a downtrend, so we are looking for supplies. So here becomes a supply level. Now whilst identifying the supply level, only focus on the candle body. We are not talking about the wicks. The wicks are not really part of the body when identifying it. But when it comes to taking a trade, that is when the wicks also have their duty that I'm going to share with you later on. So now here is a clear supply level. Why is it a supply level? Because this bullish candle is smaller than this bearish one, and then from this area here we can see that there was a powerful move away from it. And now considering the pattern we are trading, whereby the market needs to give us a structure of this kind, it comes down, where the market needs to give us a structure of this kind, give us a liquidity level, come back up, and then continue. So now looking at this one here, this market has actually given us the liquidity level here. I'm going to use this candle here as a liquidity, because after the market left here, it gave us this major pushback, this major push here. So you can use this one, or you can use this other one. The reason I'm using this particular one is that when you go down to the lower time frame, you're going to see that there was some mini buying powers within this area. So let me just go down to the 1 hour. Now you can see within this area here, we had some mini bullish attempts falling into the market. So for that reason, I'm just going to stick over to the 4-hour time frame. So from here now, what we are simply waiting for in this case is that what we need this market to trade back from here into here, and then we'll get to short it from here. This is simply the strategy, simple and straightforward. So we'll get to short it from here. Now, whilst taking the trade, here's another thing I need to let you know when you get a pattern. Now, your entry point must be after the market. Let me say, let the market comes into this area here. That doesn't mean you take your trade. You need to wait for the market to give you, for example, if you want to take a sell trade from a supply level, you need to wait for the market to give you a bearish close outside the level. So you need to get a bearish close. So once you get that bearish close on your supposed time frame, and the 2 time frame I recommend is the 1 hour and then the 30-minute time frame. Don't worry, we are going to do a back testing right now. So once you get a bearish close like this, then you take the trade and then target the previous low as your overall take profit, and your stop loss right above the level like this. So when the market goes against you, it simply taps you out without having you risking much. So this simply means a 1:6 risk to reward, smooth one. This is simply how it is. Now, if it's for a demand level also, it's the same thing. Now, looking at this market right now, we have a clear demand level over here. Here is a demand level right here. Here is a demand level. You can see the bullish candle here is smaller than this. You can see the bearish candle here is smaller than this bullish candle that left the level. So this simply shows that what there is more So let me just extend it. So this simply shows that there's more buying power from this level here. So whenever the market comes into this area, it's a decent opportunity to take a buy. So looking at here right now, you can see that here would have been your liquidity level. This week here, you can use this week here, or you can use this area here. So for me personally, I use the one that is more closer to the level, which is this week here. That's what I'm going to use as my liquidity level. Now I'll just have it marked out like this. So now in this case, what you are simply waiting for is that we are waiting for this market to come into here like this, give us a bullish close. It doesn't matter if it's come this deep. All we simply want is that we want it to tap this demand level, give us a bullish close like this, or just give us a bullish close outside this area, and then we take a buy from here, our stop loss right below here, and then our take profit at the previous high, which is this one here. This is also a solid 1:4. This is simply it. Now with all of this breakdown, let's get straight into the part whereby I do a live back testing for you to actually see how this strategy works. So hello guys. Next up, let's actually do some back testing like I do with every other strategy I share here on my channel. So now from here, let's actually take a look at the market on the daily time frame. Now on the daily time frame, we can see that we are clearly in a downtrend. You can see we are in a very strong downtrend from this point here, where the market gave us this break to the downside. However, we need to be very cautious of this area as well, because this is a very key level also. You can see it's a support level, very key one as that, with triple touches. So we need to be very careful of it as well. Now with this marked out like this, next up is simply come over to our 4-hour time frame to see how the market is reacting and identify our levels. So looking at the 4-hour time frame here, after this shift here, the market gave us a break of structure here. As you can see, we had a break of structure here before the market started bouncing upward. As you see from here, the market is bouncing upward. So here is a supply area in the market. Since it's a downtrend, we are here to identify supplies. So here is a supply here, very close to what led to the break of structure, the market shift here. So we have a supply at that point. And then let me come over to the 1-hour time frame. Okay, on the 1 hour, it's not really valid, so it's valid on the 4-hour time frame. It's a 4-hour supply level. Now, after this, your liquidity, very important. Remember, the market is a downtrend, so we are more cautious. We are more focusing on that direction. Now, we have it here. Now, let's see what the market does. You see, the market did not get into it. It just tested this area here and then quickly fell off to continue its downwards movement. So for that, let's mark this area here. Then come over to the 1-hour time frame. On the 1-hour time frame here, we see we have a supply at this point here. Here is a clear supply at that level, with this equal highs as your liquidity. Not necessarily equal highs, but almost equal highs, so I'm just going to have it like that. So now, when the market comes in here, gives us a bearish close, we take it. Okay, so let me just move it over to the 4-hour time frame for us to get there faster. So now let's see it play on the 4-hour time frame. Market couldn't touch it. You see, the market did not get into it. Since it did not get into it, we can't identify it either. So for that, we move this level back here, which is a new supply level being created. So you simply have to keep moving your levels to follow the market direction. That's very important. Here becomes a liquidity level to watch out for. Now, as looking at all of this, we still need to make sure that what the market is still respecting its downtrend movement, which is still doing. So we are still waiting for a push to our levels. Now, this is the reason why you are trading a lot of pairs. If you are trading just one single pair before, you have to wait all this while. That's why you are trading multiple pairs in the market. So whilst you are waiting for this one, you could be trading any of the other pairs. So let's see it happen here. Is it going to get to our entry? Okay, this one looks like it's going to get to our entry. Okay, you can see this one did not get to our entry. It quickly broke out of the level here. And by breaking out of this level here like this, we could only say one thing, is that the market has given us a change to the upside. So for that, I'm just going to move here over and the tag here as 1-hour market shift. So now remember, we also have a very high old level here that we are looking into to trade. Have a old level here. But now if you look at this old level right now, look at the momentum in which the market used to approach it. It's very obvious that what the market might be preparing for a buy side now. Because most of you, the mistake you make is that you tend to trade every single level provided the market comes into it. But looking at this particular market right now, the market approached it in a very high momentum way. This simply means one thing. Simply means that the buyers are very strong in the market. So for that reason, I'm not going to trade this level. I don't care if it will play out, but I'm not going to trade it just because of the way the market approached it. So for that reason, I'm going to identify the demand that the market created here. So here is the demand level the market created. So that's what I'm actually going to identify instead. Now I'm going to wait for it to give me a reason to buy it from this demand. Okay. So let's see if we get a reason to buy it from this demand. As we would have gotten a decent sell as well, but that's simply how I do it. Once the power in which the market approach the level is too much, I just get out of it. So let's see what happens at this demand level. Okay, here the market gets to the demand level. You can see with this bearish candle gave you this bullish close. So based on our entry, immediately we get this bullish close here. We take a buy from the close, our stop loss below here, and then our take profits stays at this top here. That's a 1:7. Is it going to play out? I don't really know. So now let's play it and see what happens. You see, we got a solid 1:7. This is simply how I do it. Now I always consider the momentum in which the market gets there. For those of you who will be asking, where is the liquidity in this market? Well, for this particular market, remember I told you earlier on that the 30-minute time frame is part of what we are doing. We are going to get a 30-minute liquidity, which is where the market made a mini pullback. So we have the 1 candle liquidity, the 2 candle, and then the 3 candle, and different sorts of liquidity. So you just have to know which of them. So for me personally, I always use the nearest pullback to the level as my area of liquidity. That is the only one I look out for. Any other liquidity apart from that one, I don't really care about it. So now let's see if we can catch one more trade using the 30-minute time frame. Here is a 30-minute demand area here. So here is a 30-minute demand here. You can see the bearish candle before this big bullish one. So now let's see if the market comes into it. Okay, this one here, the market just give us our liquidity area here. You can see from here there's no major pullback. The only pullback we have here is this equal lows. Now if this market taps out here, then we are going to identify another demand level here, but let's wait if it will do that. Okay, it eventually taps out that area. For that reason, we have a new demand here, and this demand here comes with this liquidity area here. So I'm just going to remove this one here. We are just following the market direction. We are not trying to challenge the market. We just want to only follow the direction the market is going. Is it going to come in? Okay, it did not come in. So looking at the 1 hour time frame, nope, the market hasn't given us a reason to change direction either. So let's see if we can get another demand area here. Here is not a demand level. This one has been mitigated. This is the only demand level we have here now. Now let's see what happens. The closer the demand level, the more riskier it is. Market gave us some equal lows here. So you see how you see that opportunities don't come often, but when they come, you're eventually going to hit it big. Now this is the advantage of this particular supply and demand strategy. You are not going to get opportunities like every 20-30 minutes, not at all. But then if you are trading the 15-minute time frame, the 5-minute time frame, you are going to get a lot of opportunities for sure. But when you are trading it on the higher time frame, opportunities don't come that often. But whenever it comes, you are definitely going to get a very good risk to reward. Like for example, the first one we caught was 1:7 risk to reward, and then this one that is cooking, I can't really tell until the market gets here. So let's see if this one also plays out before I end this video. So let's see. Okay, a quick tap in, did not break out of it, so we are okay. And then a bullish close here, we take a buy. Our stop loss below here as usual, And then our take profit, we look at the overall high as our overall take profit. That's, and that one is to 7. And then our take profit one is at this level here. Let's see if it plays out. This one looks like it's going to fail, but let's just watch it. Did not fail. You can see it clearly that it did not fail. Our take profit one is already triggered. That was 1:4. So now let's see how it goes. Boom. Our full trade got triggered at the end of the day. So this is simply how this strategy works. It's very pretty much simple and straightforward. Now this is one thing I do with all my tutorials. I do the main tutorial. I give you my back testing, with you seeing the market movement and me doing it at the same time. So hope you find this video helpful. Don't forget to smash that subscribe button, like this video, and tell me what you feel down in the comment section. So this already said, have a lovely day. Bye.